Now, there's some other things that we have to be really cautious with on this data. The Canadian real estate roller coaster continues to get worse. As inventory levels in Calgary hit the lowest numbers since the 90s, Toronto real estate sales fell to 3,100 last month, and housing prices in that market are down 14% year over year. And on top of all that, the rental market is tightening across the country as we see higher demand for rentals. And a new report from Stats Canada is suggesting that 20 to 40% of housing supply in Canada is owned by real estate investors. And that report has serious implications for the Canadian real estate market, especially if it becomes a widely held belief that real estate investors are responsible for higher home prices in Canada. However, it's my belief that it's not, and CMHC's data backs that up, which I will show you later on in this video. But before we get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button, and hit that like button so more people like you can see this video. And don't forget, if you want my new book, Mortgage Secrets, go to mortgagesecrets.ca, pay the shipping and handling, and I will send one of these to you. And I'm going to forewarn you, I keep stretching this out, but as soon as this book goes on Amazon later this month, they will all be gone and this deal will go away forever. So go to mortgagesecrets.ca in order to get your copy. Okay, so we have a ton going on in the Canadian real estate market this month. We have data from all the real estate boards with a couple of different things going on in different cities. And we've got the Bank of Canada who will release the minutes from their most recent meeting to shed further light on how they're making their decisions with respect to interest rates, which will be really interesting. That comes out tomorrow. So hit the subscribe button and the notification bell if you want to see that early tomorrow morning. And on top of that, for the first time, we got real data from Statistics Canada on the number of investors that are holding properties in the Canadian real estate market. And these are really interesting numbers, but they come with some significant dangers, which I'm going to get to a little bit later on in this video. But believe me, you have to be careful when you're interpreting this data, because if it is interpreted wrong, it could lead to even greater issues in the Canadian real estate market if the government decides that they're going to go ahead and try to stop real estate investors from being able to invest. So let's jump into the headlines first and foremost and talk about what's going on in the Canadian real estate market. So from BNN Bloomberg, January's new listings hit levels not seen since the 90s in the Calgary real estate market. Now, this is really interesting because the last time that inventory levels got low in Calgary, I was a very new mortgage broker. I was new to the industry. It was about 2005, 2006, and the market shot up. There was not enough houses out there compared to the number of buyers. It led to bidding wars, and it was a really crazy time in the Calgary real estate market. And I'm hoping that it doesn't turn into that again, because I have a big belief that people shouldn't be buying in markets where there's craziness. And it seems like that potential craziness is coming a year or two later than it did in other markets like BC and Ontario, as we see more and more people migrating towards Calgary and trying to buy properties in this area. Now, in contrast to that, on the other side of the country, Toronto's housing market enters a deep freeze with only 3,100 sales in January in the Toronto market. That is an absurdly low number, especially for a January. And it is a very close number to the number of sales that were seen in December. Typically, you expect to see a higher number of sales in January in any real estate market, because obviously December is a shortened month with respect to sales activity, because Christmas and the holidays tend to impede on the number of potential transactions in that month. Now, where it gets interesting is you're starting to see the lower prices reflected in the year-over-year data. The Toronto real estate market's benchmark prices were down 14% compared to the year earlier. Now, expect that in February and March, you're going to see this number go up as current home prices get compared to the previous peak. So we've got these contrasting markets. We've got markets that are coming down, sales are coming down, and we've got markets where low inventory is supporting the real estate market, and we're seeing some flatness in prices like we were seeing in Calgary and Saskatchewan and Manitoba, with the potential for prices in those markets to increase in the coming months. Now, obviously, that will be negated if there's a significant amount of inventory that comes onto the market, but it just doesn't seem like that is going to happen. And let me show you why. According to a new report from CMHC, rental markets across Canada tightened in 2022, and this led to both higher rents and lower vacancies. Now, keep in mind the lower vacancy part, because as we get further on in this video, that is going to become very, very important. But on top of this report, we saw that Stats Canada has for the first time released data on investors in Canada. And the numbers here are really, really interesting, because depending on the market, 20 to 30% of properties in Canada, it appears, are owned by investors now. And surprisingly, this number is not as high in one of the hottest real estate markets in Canada, which is Ontario. You might expect that this would have been super high, but it's not. In BC, the number of investors is one of the highest in the country. However, in Ontario, it lags compared to other markets, including Manitoba, New Brunswick, and Nova Scotia. Now, the sad thing about this data is that we don't have the data for the entire country. But what's really interesting is it sheds some light on what's going on in different markets. For example, in British Columbia, there's a high percentage of investor occupant owned properties. This is because Vancouver has more lax rules with respect to secondary suites. And as a result, you see a lot of people owning the property and having mortgage helper suites in the property as well, where they're renting out to other people in order to support the payments that they need to make on their properties. And this is why you often see the affordability numbers for Vancouver so high, where such a high percentage of incomes need to go towards housing. But that affordability number ignores the fact that a lot of people have tenants living in their own homes. Now, when you start to look at this data, you may infer that the high percentage of investor ownership, so basically 1 out of every 5 properties in Canada being owned by an investor, is what led to higher prices in the Canadian real estate market. But let me be clear on this, and I mean really clear on this. What led to higher prices in the Canadian real estate market was not increased activity from real estate investors. Yes, that had a small part to play in it. However, it was low borrowing costs and changes in people's preferences that led to the higher prices. Not a whole bunch of investors getting into the market, but in a lot of cases, people leaving their downtown properties, so their condos and their townhouses, and moving into the suburbs as they sought a significantly different style of life during the pandemic. And a lot of those properties ended up being turned into investment properties. Now, there's some other things that we have to be really cautious with on this data. First and foremost, we only have 1 year worth of data. So in other words, we can't compare to what this looked like in 2019 or 2018 or 2008 or any other period in Canadian history for that matter. So this data gives us a benchmark going forward for the years to come, but it doesn't necessarily mean that a whole bunch of investors flocked into the market, and therefore that's why we have higher prices. Now, yes, it is part of it, but even leading up to the pandemic, we saw home ownership numbers dropping quite substantially. And even the Stats Canada report shows that home ownership dropped from 69% to 66.5% from 2011 to 2021. And this isn't necessarily because of an affordability issue, but because of the fact that up until the pandemic, millennials had made drastically different choices than their parents when it came to home ownership, wanting to have the freedom to travel and not being stuck to any single place. But that changed during COVID. And as a result, a lot of millennials and a lot of investors started to jump into the real estate market, which those two things combined obviously led to higher prices, but so did the lower cost of borrowing. When it became so much cheaper to own rather than rent, people jumped to the market and therefore home prices went up, especially as people started to believe that they would be priced out of the real estate market forever. But here's where the argument that real estate investors are to blame for higher costs of housing comes to an end. And it's also where the blame on landlords for higher rents comes to rest as well, because here's the reality of what's happening in the Canadian real estate market. We are seeing vacancy rates at all-time lows. And if you look at the numbers in the data, what we are seeing here is that there's clearly a shortage of supply, not only in the amount of homes available to buy, but also in the homes available to rent, because vacancy rates are now under 2% across the country, and that is leading to higher rents. So the argument that real estate investors are to blame for higher real estate prices just doesn't hold weight, because what is clear is that there's more demand than supply for housing, both in the resale market and in the rental market. And as we ramp up immigration, as more and more people come to the country, we're going to see this get worse and worse and worse. And as we see higher interest rates and less building activity due to higher costs to build, well, it's only going to get worse. And I think the real blame here goes back to the 1980s and the 1990s, when they stopped subsidizing purpose-built rentals and basically created a scenario where they tried to encourage more homeownership. And that encouragement towards homeownership led to less purpose-built rentals being built. And as a result of that, we found ourselves in a place where we have substantially less supply than is needed. And the fear here is that the government gets a hold of these numbers and goes, we need to stop real estate investors. Well, real estate investors have a purpose in the real estate market. It is to provide affordable housing for people to rent that otherwise wouldn't be something that they would necessarily buy. And I can tell you right now that I don't have a crystal ball on many things, but if you stopped real estate investors from being able to buy real estate, you would probably have 2 problems. The first would be that housing prices would not come down substantially, and that any changes would have a very insignificant impact on prices. The second would be all the properties that are beaten up and worn down and just not places where people want to live would not get refreshed. They would not get turned into housing that people want to live in. And as a result, we'd find ourselves in a situation where we would have a lot of really crappy properties that would be sitting vacant. Now, this might help with lower rents. However, it would also lead to a pretty significant amount of stigmatized property that would never get bought. So the reality here is that government intervention in this scenario is not a good idea. And that's the whole purpose of this video, is to say the real estate roller coaster that is happening is the result of basically free markets acting upon themselves. And this period of time that we saw early on in the pandemic, where a lot of people were jumping into the market, will ultimately turn into a place where people will jump out of the market a few years down the road. This happened before when we saw people jumping in to be real estate investors, and then they started to realize that they didn't necessarily want that job, and they started selling their properties. That's very much what happened in 2004 and 2005, and it will happen again. As people realize that they don't want the burden of owning these homes, they will put them on the market, and eventually there will be more supply for people to buy. And as rents go higher, more people will want to own, and there will be a natural balancing to the market if we let the market act the way that it's supposed to. And I know for a government that seems really hard to do, but trust me, it is just what needs to be done. Because if you leave markets alone, they have a tendency to balance themselves out. Now, if you want more information on the Canadian real estate market and you want to know what's forecasted to happen in 2023, make sure you check out this video here.